So in this video, we're going to be talking about how inheritance tax works, what are the changes, and 5 easy ways you can pay less of it. What are the changes? But first, let's just cover the basics, because people, understandably, I might add, might not really be fully aware about how inheritance tax works. It's notoriously complicated and absolutely loophole-ridden. Firstly, it's a pretty high rate charged at 40% on the value of someone's estate over a tax-free amount of £325,000. But, and lots of people get this wrong, it's a marginal tax, so you only get charged on the part of your estate that's above the £325,000. So, for example, on an estate worth £335,000, the tax would apply to the additional £10,000, not the full estate. But as always, there are some exemptions. Any estate that's valued at less than £325,000 is tax-free. That's been fixed until 2030, but more on that later. Anyone who leaves their estate to a husband, wife, or civil partner is exempt as well. And if the person who dies leaves their home to their children or grandchildren, the threshold goes up to £500,000. But again, we'll come on to this bit in more detail later on. So when you combine 2 of these exemptions, it basically means that the estate of someone who can use their late partner's allowance and give a home to their children or grandchildren won't be liable for inheritance tax for anything under £1 million. So those are the basics. But now we move on to the pretty big news, which is that pensions are actually included in the overall value of someone's estate, therefore making them liable for inheritance tax. For a long time, a mantra existed that you should spend your ISA first and then leave your pension last. The simple idea was that your ISA has always been in scope for inheritance tax and that won't change, but your pension didn't. So it made sense to spend the thing that was taxed so that you could preserve the value of the thing that wasn't taxed to pass it on to your beneficiaries. But now, from April 2027, pension pots and death benefits from pensions will be included in the value of your estate and therefore attract inheritance tax. And this is a big one. It's a really key change and really should be prompting people to ask about how they're using their pension and if it makes sense when it comes to estate planning, inheritance tax, and even how they're funding their retirement. So to illustrate this, let's go through an example. The problem is that people invariably run into this as their house might be worth, say, 300k, they're below the 325k limit, but their pension is worth 100k on top of that. Under the old system, they wouldn't have had any inheritance tax to pay. But now, when you combine the house and the pension with the 325k limit, you can pretty quickly start to end up with a hefty tax bill of £30,000. £300,000 for the house, plus £100,000 for the pension, less your £325,000 allowance leaves £75,000 liable for inheritance tax. Charged at 40% gets you to your £30,000 bill. No small sum of money, you might be thinking. But the other change that I want to discuss is the really sneaky one. At the moment, only about 4% of estates pay inheritance tax. The very rich don't pay inheritance tax because this guy inherited £9 billion and paid £9 million in inheritance tax, and even with my rudimentary math skills, that's not 40% of 9 billion, but no matter. And if we're honest, for the most part, most regular people won't end up paying inheritance tax either because their estate will likely fall below the thresholds. But this 4% number is going to increase as these bands are frozen. So what does that mean? Well, as we mentioned earlier, the tax-free threshold has been frozen until at least 2030. This is a process called fiscal drag. As the value of people's assets increase in line with inflation, more and more people will get dragged into higher tax bands, and in this case, potentially taking them over the £325,000 limit. You add in that people's pensions will also be included, and with the example that we just went through, it's going to pull a lot more people into being liable for inheritance tax. The latest figures show that only about 4% of estates pay inheritance tax at the moment, but before the changes were announced, economists at the Institute for Fiscal Studies estimated that 7% of estates could be liable for inheritance tax by 2032. And frankly, it's easy to see why more people could get dragged into paying inheritance tax. The average house price in the UK is £267,200 as of October numbers. If house prices increase 3% a year, then in 7 years' time, the average home in the UK alone will be enough to have the average family start paying inheritance tax, even before you start including people's pensions. So the short answer is, it may only be 4% now, but it's soon going to be a whole lot more. You add in the pension pots too, and the numbers are going to get even higher. And this also leads us to another interesting problem, which is that the £325,000 nil rate ban has gradually increased over time. When it was originally introduced in 1986, when inheritance tax was introduced, replacing the capital transfer tax, the nil band was £90,000. It's gradually gone up over time, but it has been sitting at £325,000 since 2009. Average price of a house in the UK in 2009, £157,200. So compare that to the 267 grand average house price on a 325k allowance, and the gap between the average house price and the inheritance tax allowance has gradually been getting narrower and narrower over time. So I hope that all this data and all this information really illustrates the point that I'm trying to make. It is true to say that inheritance tax at the moment is only paid by a small number of generally better off households, but it is also true to say that the combination of freezing rates and including pensions in the value of someone's estate, more and more people will find themselves liable for inheritance tax. But let's just look at an example of how this might affect someone. Let's say John, someone who you could borrow power tools from. John owns a fully paid for house worth, let's say, £400,000. He's got 50k in ISAs and 250k in a pension. If John were to pass away today, he'd have no inheritance tax bill to pay. That's because his inheritance tax nil rate band of £325,000, which we've already discussed, and he leaves his home to his wife, kids or grandkids as well, and his estate would also benefit from the resident's nil rate band of £175,000, meaning that he can pass on £500,000 free of inheritance tax, which we've already discussed. With the current state of inheritance tax, he's in the clear, getting off scot-free. Because his pension isn't included in the value of his estate, his taxable estate will be £450,000, his house plus his ISA, so no inheritance tax would be due. His ISA plus his property falls below 500k, so he's all good. But this is where things start to change. From April 2027, John's pension will fall inside of his estate for inheritance tax purposes, and this means that instead of paying no inheritance tax on his estate at all, he will now get an £80,000 bill. And this is where the tax changes really start to take big chunks out of the value of people's estates. But we've already alluded to it a minute ago, and there's another really important point that we need to cover. If our boy John was married to, say, Jane, then John and Jane would have two sets of inheritance tax allowances, and this means that they could pass on up to £1 million without paying any inheritance tax. They get two lots of £325,000, and they get two lots of £175,000, provided they leave their house to their children or grandchildren. So as long as events go something like this, John dies, then his wife Jane dies, and in between John and Jane dying, their estates don't breach the £1 million limit, there is still no inheritance tax to pay, even after the changes that we've already discussed. And this is really where tax and estate planning comes into a world of its own. It's making these sorts of plans that can really make such a difference to managing your estate and your affairs and any inheritance tax that you might have to pay when you pass. So with all this doom and gloom about pensions, potential inheritance tax bills on the way for us all, it's pretty reasonable to ask, well, what are some of the ways that you can pay less inheritance tax? There are a few main mechanisms that you've got at your disposal, so let's walk through them now. You can make annual gifts. You can make tax-free gifts of cash up to £3,000 per year to your children. You can also carry any unused balances from the previous year into the current year, but only for 1 year, so that's a maximum of 6k. This can be a really easy way to just straight up pass cash on to your kids. Christmas presents, birthday presents. It's also worth noting you can only make one gift of £3,000 per year. And since the cost of weddings is absolutely stratospheric and astronomical, you can also give a gift of up to £5,000 to your children when they get married, free of tax. You can also take advantage of the 7-year rule. Take a look at this. This allows people to make significant gifts to children and not have to pay any inheritance tax. Take a look here. No tax is due on any gifts given if you live for 7 years after giving them. If you die within 7 years of giving a gift and there's inheritance tax to pay on it, the amount of tax due after your death depends on when you gave it. Gifts given in 3 years before your death are taxed at 40%. Gifts given the 3 to 7 years before your death are taxed on a sliding scale known as taper relief. Taper relief only applies to the total value of gifts made in the 7 years before you die over the £325,000 tax-free threshold. If you go over the inheritance tax-free threshold, gifts will be completely free from inheritance tax if you live 7 years afterwards. So we should just be clear, serious amounts of money have to be changing hands, but again, it's another really good way to potentially offer cash gifts to your kids. This leads us to regular gifts out of income. Let's be geeky for a second. The relevant legislation is found in section 21 of the Inheritance Tax of 1984. Some nice nighttime reading for you there, but whilst we're here, let's get into it. You can make gifts of any value out of your regular income. These gifts are exempt from inheritance tax purposes, and it's completely irrelevant whether or not you survive for 7 years, so the taper rule doesn't apply. But in order to qualify, the gift has to meet 3 conditions, which are it formed part of your normal expenditure, it was made out of income and therefore not out of savings, and it left you with enough income to maintain your normal standard of living. Think of things like mobile phone bills, car payments, leasing costs. Recurring costs that a parent can cover are exempt from inheritance tax and also don't have to abide by the 7-year rule. One of the most important things and most overlooked things, I think, is to write a will. If you don't, and that's ultimately because if you don't state how you want your assets to be divided, then the law decides for you. And that means you can end up paying even more unnecessary taxes to HMRC, who'll be rubbing their hands in glee. And this last one is a bit of a morbid one, but again is really, really important, which is to seek financial advice. seeking professional advice from someone who's qualified, registered, and can tailor a plan to your goals and to your experiences, to your income, to your level of wealth, I think is a super efficient way of spending your money. You might have to fork out a bit of money for it, but when we're talking about these quantities of money, your lifetime savings, the decades you spent paying off your mortgage and buying a house, I think it's money well spent. And, you can all just ball out, live balls to the wall and spend your money, enjoying time with your kids whilst you're still around. That's a great way to not have to pay inheritance tax. But it comes with an important caveat, which is you might not be leaving them with as much as you might have hoped. But if you're married and are under the £1 million thresholds, then £1 million is a pretty nice gift to get nonetheless. But my personal opinion is that we're going to see people giving away more of their money to their kids and giving away more of their estate earlier on in their life than they might have done ordinarily. Instead of cash lump sums, maybe a parent makes a contribution to their kid's mortgage, helps them pay off their student loan, maybe contributes to their grandkids' ISAs every year. Things like that can make a really, really big difference, especially when it comes to grandchildren. So in conclusion, what is the God's honest truth? So what's the conclusion ultimately here? Well, I think it's safe to say that with a combination of freezing thresholds, increase in house prices, and now that pensions are getting included in the value of people's estates when it comes to assessing inheritance tax, more and more people are going to get dragged into having to pay inheritance tax. But the truth of the matter is, as we've discovered, there are a few things that you can do quite quickly, quite easily, and don't necessarily involve vast sums of money or huge quantities of money to be spent on professionals in order to help mitigate some of your inheritance tax liabilities. But having said that, if you are going to seek help, make sure you seek help from someone who is qualified, recommended, and has all the necessary accreditations. When you're talking about your life savings, a house you've spent decades to pay off a mortgage for, spending a bit of money on getting proper qualified financial advice will pay you dividends unequivocally, no matter what. Thanks very much for watching. If you've liked this video, check out some of these other videos here. And as always, feel free to like and subscribe and share with your friends. Thanks very much for watching.